A kind of a update, tax-wise, government tax-wise, I guess. But we have our good sponsors and members helping us out on both the 401k front as well as with our tax IRS issues. So first, we're going to have Navigate Financial, Ben Driggs and DJ Bassett, who have been helping us in our UPHCA 401k program. If you haven't talked with them, and that's a great way to provide some good benefit to your employees, and they have some great the expense to the 401k. They seem to have some good programs that won't cost a great deal of money and are cheaper than maybe the other programs that you're already using. But anyway, let's turn the time to Ben. Ben, we'll just let you run with that and share with us some of the issues, concerns, or updates the 401k has with right now.
Okay, thanks, Dave. And for the other viewers, we appreciate you taking a few minutes. So my name is Ben. DJ's here in the office with me as well. And we help companies run their 401k plans. We appreciate the relationship with UPHCA and want to be a good partner there for its members. So what we've been working on for the last 2+ years is trying to take advantage of where the 401k industry is headed. And that is, we're trying to help the small business owner, because everybody knows Congress is aware of the challenge, Department of Labor, the market providers, the private sector, everyone is aware of the challenges small businesses face. So we're in the middle of what we think is going to be, over the next decade or so, a transition from employers having to run their own 401k plans and being responsible for the administration, and every year they're testing and IRS filings and things like that. We're trying to shift that away from the small business. So there have been some legislative changes that came down the pike a couple of years ago. This is what started it all. And there's some more legislation that happened last year, and then we are anticipating some more this year. All of that is going to be slowly moving the burden away from the employer. So what we put together is, based on this legislation, we have put together a group 401k plan so that small businesses can group together in somewhat of a cooperative basis and a co-op basis, that rather than just doing their 401k themselves, they're going to be bundled with other people. The companies still retain the customization for their own plan design. So you're running your 25 people in your plumbing company, and you have matching, or you don't do matching, or vesting or eligibility. All those things are still retained at the company level, but things such as administration, general governance issues, oversight, investments, those things are bundled together so that we can save on cost and increase efficiencies. So there are 3 primary benefits of joining a group plan, whether you're considering starting a 401k plan for the first time, or whether you have an existing plan. All these would come into play. The first is we're reducing cost compared to doing your 401k by yourself, which is kind of obvious if you have a whole bunch of people. We have now coming up on 25 plans. We're pricing the plan at $25 million in collective retirement plan assets. So if you have a small company and you have a few $100,000 in your 401k plan, you're going to have higher fees than if we're pricing this as a $25 million unit. So that's pretty intuitive. Decreased cost. Also, as mentioned earlier, we're trying to take the administrative burdens away. We are doing more work. Congress is allowing that, and the market is responding. So whereas before maybe you have to do 20 things to run your 401k, maybe you have to do 10. So there's still some work to run a 401k plan, but we're taking that off. And then we're reducing the liability by taking on more of those responsibilities. And again, laws are being changed and the industry is responding by saying, hey, we'll take full responsibility for the investments. We'll take full responsibility for the administration. So lower cost, lower administrative burden, and lower liability. Lastly, for larger companies who have more than 100 employees, we are launching a plan that allows for everyone to group together for the purposes of one audit, and that is coming down the pike this year. So if you know of any companies that have 100 people or are approaching 100 people, right now they have to do an annual audit. It's expensive, it's a hassle, no one likes it, and so we're trying to remove that as well. So those are some of the talking points. DJ, do you have any other comments?
No, I think you hit everything.
Okay. Any questions about that?
So what you're saying, Ben, is that this is kind of a co-op where a group of companies come together, share the costs, but the savings most especially in administering, as well as I know when I was in a former life, I was the one that took care of the 401k program, and that was a big hassle every year that had to deal with the paperwork, and it's complicated. And so this really reduces some of the issues and time that a business owner has, but it's also a huge benefit to the company and a great way to retain your employees. So thank you. Now, are there any changes? You mentioned briefly some of the structure changes, but are there anything, how much can they contribute? Has that changed at all?
Not meaningfully. I think it increased by $1,000. You know, the maximum contribution going from 19,500 to 20,500. You know, but that's a big number. So those things don't change much from year to year. If you're a new company considering starting a 401k plan, there's some tax incentives for doing so. So we can talk about that. But with labor shortages as they are, companies need to be competitive. And so we are working with several new companies who are coming on board who are doing this not only for their employees, but also for the sake of the company to be competitive, to say, you know what, we really need to be offering this benefit. But a lot of people wonder, well, do I have to put in money? That's a different discussion. A 401k plan can cost the company a lot of money or a little money, depending on how benevolent the company wants to be. If they want to throw a whole bunch of money at the employees, then it costs them more money. But they could even set something up and not put in anything, and at least to have something. So we can talk about that.
Well, thank you very much, Ben and DJ. We appreciate your being part of the UPHCA and providing that great service to our members. So thank you very much.
We appreciate participating. Thanks so much. We'll hop off and let you guys talk taxes. Otherwise, it's just from 401k to taxes. We'll all fall asleep here. Okay, take care, you guys.
Thank you. Take care. So now we're moving on to Steve. Steve has been a fixture in the association for a lot of years, and he provides us great class every year, and we appreciate it very much. Gives us some insight into our wonderful taxes, and they're very complicated. It's probably almost like a voodoo type thing. Steve, you seem to understand that voodoo that in the tax laws, but we appreciate you being here. So we'll turn the time. Go ahead and share your screen, and we'll just let you go with it. CLA is a great partner and sponsor of our programs here. So again, thank you very much, Steve, for your efforts.
All right. Well, thank you, Dave, and welcome everybody. I don't know. How many people do we have on, Dave? You can see. I see Mr. Ty, but I assume there are others. Well, yeah, I appreciate being called a fixture, but I guess I want to make sure that that fixture is not a toilet. Okay, there you go. You know, I want to be one of those really spiffy sinks with the water spigot that you just wave your hand and the water comes out at whatever temperature you'd like. Yes. But well, yeah, CLA has been a part of the organization here for, boy, at least 10 or 12 years, maybe more, Dave. And we are a construction CPA firm. A good portion of our clients are construction. I kind of cut my teeth over the years. I've been doing this about 25 years and have been doing construction contractors in Utah since then. But you know, today I usually generally have a presentation on just a lot of general things that probably a lot of you already know about. Pension plan deductions, depreciation, things like that you all probably are already doing. But I wanted to talk to you about something today, or at least highlight something that we've been doing for the last year or so since this was available. There's been, as you may well know, there's been a lot of free money flying around the economy and hopefully flying into your bank account. Everybody knows about the PPP loan. And, you know, we probably helped, 50 to 80 clients, with their PPP loans and dealing with that. And those were fairly simple to qualify for and fairly straightforward. But today I want to talk a little bit about some specific things that again we found to be I want to talk about the employee retention credit, and I don't know how many of you have heard of this or not heard of this, but it's what I would call kind of a stealthy tax benefit that, all of these things I'm going to talk about today are things that, the IRS is not going to send you a notice after you file your tax return and say, hey, well, yeah, so the employee retention credit is one that we're still working on. It's been available for the last year or two, and we've still been finding more and more clients and new clients that have come to us and said, gee, do I qualify for this? And they do. And many times, a lot of these incentives were based on, well, yeah, you had to show that you really got hurt by the coronavirus and you lost employees, you lost business. But this one is a little more stealthy in that it's a very specific way to qualify. And even if you might have had a better year in 2021 than you did in 19 before the virus hit, you still can qualify. So I'm going to get into some of those details on the employee retention credit, and you guys can always get back to me if you have any questions. And again, during this presentation, please, don't hesitate to interrupt. If you do have any questions, I'll have my contact information at the end, and you can shoot me an email or give me a call anytime.
Steve, I've got a question. Yeah. I thought the ERC would only go through December 31st. So if you haven't hopped on, you can still hop on?
You can still hop on. Yes, it did. It actually expired at the end of September, the third quarter, and I'll get into some of those details. But it still applied in 2020 as well as those first 3 quarters of 2021. And yes, you have 3 years to apply for this. So it's definitely something that if you're not aware of it, or your accountant or tax person, payroll person has not helped you with this, it's still available to you.
Great, thank you.
Yeah, and then I'm going to just talk about some other tax credits and planning opportunities that we've been working with our clients on a lot. And then a quick discussion of the crystal ball that I have here, right here in my office somewhere. It's not quite as clear as we thought it was going to be, but I can talk a little bit about some of the stuff that may be coming down the pike in terms of tax law changes. But yeah, let's start with the Employee Retention Credit, the ERC. And basically this was introduced way back in the spring of 2020 when the pandemic first started. And again, there was the PPP loans, which most of you are familiar with. And then the ERC also was introduced at that same time. However, the rules back then allowed you to only do one or the other, okay? And the vast majority of our clients, you know, took advantage of the PPP loan. Therefore, we didn't spend any time on the ERC because you couldn't do both. And the PPP was generally much more available and worth a lot more money. So, however, then as most tax laws seem to change regularly, in 2021, and I think it was the spring of 21, a year later, they said, okay, well, we will allow you to utilize the ERC even though you got a PPP loan, okay? Supposedly at that time, it was through the end of the year, through the fourth quarter of 2021. Then they went back and said, whoops, we're going to eliminate it for the fourth quarter of 2021. So again, the ERC applies to the 4 quarters of 2020 and just the first 3 quarters of 2021. And we'll talk a little bit about, you know, kind of what it takes to qualify. And basically, initially, it was limited to employers that had 100 employees or less, okay? And of course, then that was changed in 2021 to any employer that has less than 500 employees. So that opened the door for a lot more potential credits. But here's what you do. And it's pretty straightforward and it's real black and white. You either qualify by $1 or you don't qualify by $1 for a particular quarter. And what you do is you take your 2019 quarterly revenues, and those revenues need to be calculated based on your tax method. So that's a little nuance. This may not be something you can pull out of QuickBooks. It could be, you know, if you're on the cash basis for taxes or completed contract or a number of other methods for tax purposes, you may need to run some side calculations to really generate what those 2019 quarterly revenues are, okay? And once you've done that, then you compare those quarters to 2020 quarterly revenues, tax revenues, and then obviously the first 3 quarters of 2021. Now, to qualify for 2020, it's pretty difficult. You need to have a 50% or more decline in quarterly revenues, quarter over quarter, So in other words, the second quarter of 2019 compared to the second quarter of 2020, if you're a dollar under 50% decline, you qualify. If you're a dollar over, you don't qualify. Okay, so 2020, it's pretty hard to qualify because you have to have a drop off of 50% in revenues, and that's pretty hard. Most of our contractor clients, yeah, they might have slipped a little bit, but they certainly didn't cut their revenue in half. However, now in 2021, that difference is only 20%. So in other words, if your second quarter of 2019 was $1 million and your second quarter of 2021 was $800,000, then you qualify. And one important thing that people miss is this probably isn't the number that you pull out of your accounting records. It needs to be adjusted for your tax method, okay? And that tends to make, for example, if you're on the cash basis and you had a quarter in 2021 that you just happened to not collect a lot of cash that month or that quarter, then you could possibly qualify. So it's a quarter by quarter qualification. And that's the most straightforward way to do it. And again, you can reach out to me. It's maybe not as simple as it might seem. Reach out to us and we'd be glad to do a feasibility and help you understand if you qualify or not. And like I said, we've found a number of contractors that they thought, oh, there's no way I qualify for this. You know, I'm having a really good year in 2021 and 19 was pretty good too. So there's no way I qualify. And we found a number of them. Matter of fact, one last week, we just finished amending their return for them. They're getting a $680,000 refund. So these are big numbers again. Like the PPP, it's kind of nice to have some money show up in your bank account rather than, to offset the taxes that you're paying. So everybody that qualifies for these kinds of things is basically getting a discount on their taxes this year. So, so the main way to qualify again is by comparing those quarterly tax revenues. Another way to qualify that's a little more mushy, and we've only had a couple of clients that qualified this way, is that you need to have some damages that relate to a government mandate, okay, or a shutdown, okay? This is disregarding any of this quarterly revenue changes. If you can prove or document that your business suffered because of a government mandate. Now that doesn't have to be, we didn't have many government mandates here in Utah, but a lot of other states did, as well as, maybe a lot of your suppliers might have had some mandates that shut them down, that therefore you couldn't get the materials or whatever you were obtaining from them, and you were hurt by that. So that one's a little more mushy. But it's a facts and circumstances kind of thing. And if you have a problem or had a problem like that and can demonstrate that, then you can possibly qualify that way. And then there's a smaller version for companies that have less than $1 million, the Recovery Startup Business Credit, similar to the ERC. It's just for smaller businesses. And this is a payroll tax 941 a refundable credit. And basically the credit is 70% of up to $10,000 of wages paid to each employee. So in other words, if you're paying somebody $40,000 or more, which probably many of your employees are, then it's limited to $10,000. If you're paying them more than that, you don't get that credit, but you're getting a credit of 70% of that wage number per employee. And in 2020, that credit was 50%. So it was less. They really ramped it up in 2021 to make it be, like I mentioned, 20% reduction in revenue, and as well as it increased the credit to 70%. Owners and direct family of owners do not qualify as a employee that would possibly be able to get this credit. And the wages include your health insurance premiums that are paid by the employer. So it's not just your gross wages that you're paying. You also add to that the health insurance premiums that the company is paying on their behalf. And again, this also is available in addition to your PPP loan, if you got that. And I'll talk to you a little bit. You can't use the same wages, but so here's an example. Say there's a contractor with 330 employees. Their 2019 revenue versus 2021 declined by 20% or more. Okay. Here, let me just take care of that. We can just do that on the fly. So an example, wages for an employee of this company in 2021, they had $9,500 in wages. Okay. They also had $1,000 worth of employer health insurance costs. So they had $10,500 worth of wages plus health insurance. So $10,500. Well, this is limited, and the credit calculation is limited to $10,000 per employee. And so if all of those employees had $10,000 or more in wages and health insurance, multiply those 330 employees times 70% of $10,000 or $7,000, the particular contractor here would have gotten a credit for that 1 quarter of $2,310. So again, this can be remarkably significant. We did a calculation for a client a month or so ago, and they're like, there's no way that I qualified. You know, I'm having a good year in 21. We ran the numbers and they qualified. They barely qualified, but they qualified and got like some $600,000 or $700,000 in credit for that quarter. And the ERC used to be when it was rolling in the second and third quarter of 2021, you could just underpay your 941 taxes, you know, knowing that you qualified for this credit and offset the credit when you do your 941 at the end of the quarter. But now that those quarters are past, again, I said you have 3 years to amend those returns and apply for the credit, and it's a fully refundable credit. Now, we're told that we've had some get their money in 3 months or 4 months, but we're told by the IRS that it's likely going to take 6 months or more to get your money. But still, really, really significant. Here's some information. CLA Connect is our firm's website, and jot that down. We've got a huge number of articles, not just on ERC, but on a lot of other things. And I didn't mention before, you know, we're the #1 construction CPA firm in the country. We've got more professionals working on construction clients than any other firm. So we have a lot of construction-oriented articles also, and not just necessarily tax, but many other topics. So I encourage you to go to the CLA Connect website, and then here's just a few articles that relate to what I've just talked about that might give you a little bit more information. And we also have a number of regular webinars, at least one a month, that talk about, you know, specific tax opportunities, maybe not just for contractors, but for small businesses. So I encourage you to check that out. Well, does your business qualify for this credit? Well, you know, it would help if you had a good year in 2019 okay? And again, the calculation must be based on your quarterly tax revenues. So, for example, if you were on the completed contract method, which a number of our contractors are, you would need to produce a job schedule at the end of each quarter, do the adjustments to your revenue based on the completed contract, whether the job was finished that quarter or the job was still open at that quarter, and calculate those quarterly tax revenues. But again, like I said, we've just seen some really surprising results in that clients that we thought there was no way that they would qualify for this, they did. So I encourage you, again, let me know if you would like us to help you with this. We'd be glad to do that. All right, any questions about the ERC? Again, and I don't know if we can raise hands or if anybody can acknowledge, has anyone received the employee retention credit that's on the line? Okay, well, a tremendous benefit. So let us know if we can help. I'm going to talk about another tax credit that can possibly apply to you. Basically, we're all having problems finding people, right? And maybe we have to dig deep to find employees. We've got a call center that we do some work for, and they hire anywhere from 50 to 100 individuals every month. Okay, so they're constantly, they have 100% turnover as well. Hopefully yours isn't that serious, but we've helped them for the last few years with the Work Opportunity Tax Credit, or WOTC, and they receive anywhere from $200,000 to $400,000 a year in tax credits for hiring certain people. And basically, here's some examples of the classes of people that if you're hiring, long-term unemployed, veterans, ex-felons, food stamp recipients, etc. If you're hiring those types of people, well, what needs to happen is within 28 days of hire, you need to fill out a form, called Form 8850, that basically goes to the state of Utah or the state you're in, to have them verify that this person that you just hired is in one of these classes, and the state does that. But it has to be done within 28 days of hire. And just to throw this out there, CLA does have a program where we can hook into your onboarding system, and it's just they click on a link and are able to fill out some basic information, and we help you submit that to the state, and then follow up to see if they've been verified as being in one of these classes. And so if you do hire people like this, there's some of the numbers, anywhere from $9,000 to $2,400 in credits. I believe you do have to employ them for at least 90 days, but you apply for that credit and it's picked up on your personal income tax return if you're a flow-through entity. So again, another opportunity with free money that's sitting there on the table, but you've got to know about what's on that table. And again, Work Opportunity Tax Credit, great opportunity. Research and Development Credit. We've been finding more and more contractors that qualify for this. And basically, and this was one of the things they were fooling around with near the end of last year when they were talking about taking this away, and they decided to keep it in place. I think it's a great opportunity, because if you're working on improving a certain process or a product, or that improves the performance or functionality or the reliability of what you're doing, and includes some process of experimentation where you have a risk of loss if this thing doesn't work, It's just a matter, most of the costs are payroll costs. We've got a fairly large general contractor that does a lot of, design build type work, and they're able to quantify and account for the costs. Again, most of these costs are people costs. Trying new situations, new ways to do things. 20% of this person is engaged in R&D, 40% of another person, and if that number adds up, again, it can result in a tax credit. Both the feds and Utah has an R&D credit available, and bottom line is it's an additional credit of 15% of the qualified expenses. So, say you spend $200,000 in research and development activities, you can get a $30,000 tax credit. So this is a little more complicated, and we do have a department in our firm that helps with these things. It does cost a little bit of money for us to perform this service, but it's multiples less than the credit that you receive. And again, I'm meeting with another client tomorrow to introduce them to our R&D team, and they're a manufacturer of beauty products, and they do a lot of experimentation, and they've set up a lab to test some of their products, and basically all those costs involved in that activity will qualify, and they're going to get a sizable credit. And again, it's maybe not quite as likely in the contracting business, but if you're prefabbing things in advance or approaching a job in a different way, and you're experimenting or testing this, or people are working on trying to figure out better ways to do things, it could possibly qualify. Cost segregation studies. I've talked about this before also. If you have a building, perfect example is, the contractor has their building and yard, their office and yard. Typically, commercial real estate is depreciated over 39 years for commercial property. So if you have $1 million building, divided by 39 years, I think that's something like $26,000 a year in depreciation for taxes, okay? Big whoop. You spend $1 million on a building, you put down $200,000 or $300,000, and you get a $26,000 deduction every year for the next 39 years. Not a real big tax benefit. However, if you perform a cost segregation study, and that's basically where we go in, and we have engineers and architects on our staff that specialize in this. They go in and look at each individual component of the building. For example, electrical is usually connected to a 5-year asset, okay? Whether it's a computer or any other piece of equipment, it's a 5-year depreciation life for that asset. So therefore, the electrical, the cabinetry, the parking lot, the fencing, the signage, I can go through a list of many things that are components of that building, and typically, your accountant will just put that number, that $1 million building, and put it on your depreciation schedule and depreciate it over 39 years. Well, a cost segregation study breaks out that $1 million into different components of shorter life property, which basically gives you more depreciation up front, okay? It's no magic thing other than you're front loading your depreciation, okay? Which could offset other income. One of the things that our ex-president, Mr. Trump, And if you remember, he had there were some statements that he paid virtually no taxes a number of years. Well, he's heavily into real estate, and he does a cost segregation study on every piece of real estate that he buys. Therefore, he can front load that depreciation and offset that additional depreciation and produce losses in those entities and offset his other income. Okay, so this is a fairly straightforward thing. Again, another thing, likely the building or property needs to be at least $1 million building for this to really make sense. But we found over the years that, you know, approximately 20 to 30% of that building's cost can be broken down and identified and depreciated over a shorter life. And whether that's, you know, 5 or 7 or 15-year property, it's considerably less than 39. So again, a way to get some deductions. And this obviously applies to new buildings and new construction, but say you owned a building for 5 years and we go in and look at it and go, oh yeah, we can break out a bunch of your building into smaller pieces. What happens is there's a catch up. In other words, the depreciation that you could have taken in those 5 years, but you didn't because you just took it at 39 years for the depreciation, you can get a catch up on that. And we've done a number of these where companies have got, you know, hundreds and hundreds of thousands of dollars deduction from a building they bought, you know, 5 or 6 years ago. And it's all cut up in the current year. So you can take the deduction that year and offset other income. And again, I've talked about this before, and this is a little more complicated, but you know, most small contractors are on the cash basis, and that's a great way to look at things. Many of them are not. Many of them, you know, at the beginning of starting your company, the accountant checked accrual and you're on the accrual basis. Well, the law changed a few years ago. It used to be that contractors under $10 million could be on the cash basis. Well, they changed that to $25 million. Now it's $26 million. So if you're $26 million or less, then you can be on the cash basis, and or some of these other methods. Completed contract is a common method where you don't pay taxes on the profit of that job until the job is complete. So it's an opportunity to defer a lot of income, and especially lately when contractors have been growing and have been having a lot of new projects, it gives you an opportunity to defer taxes into the next year or into the future. And we do this with virtually all of our contracts are on a different method than accrual. Okay, just to kind of conclude things, if this presentation would have been 6 months or so ago, I would have had a list of things to watch out for that could possibly change effective 2021. Well, now we're into February, and as you might have noticed, Washington is kind of flopping around a little bit with some of this, and not a lot of decisions have been made, and not a lot of new law has been put into place. And bottom line is 2021 is pretty much in the can in terms of tax law. You know, there was a lot of talk about increasing the capital gains rate. There was a lot of talk about increasing the top tax rate. There was talk about doing away with the qualified business income deduction, which is something I've talked about before, and I'm sure you guys as contractors are getting that. It's a 20% deduction against your flow-through income. And they were going to do away with that. They were going to tweak a number of other things that could have affected your business in terms of taxes. And basically all that is gone. There's not, and none of that is going to change in 2021. Now, you might ask, well, is it going to change in 2022? Well, 2022, as we know, happens to be an election year, and I don't know how many politicians would be interested in proposing increased taxes when they're up for a re-election in 2022 in November. So likely not a lot of activity in 2022 either. However, moving into 2023, I mean, I'm telling my clients, bottom line is taxes are probably as low as they're going to be for a long time. So they are going up, but would it be something that we could hang our hat on, that it's going to happen on a certain year, a certain time? Probably not, but it's just something that we're keeping our eyes on regularly. Our firm has people in Washington that are kind of watching what some of this stuff is, some of these committees and things that they're talking about. But right now it's pretty quiet in terms of tax law changes. So you can be relatively assured that taxes are going to be the same. That's why it's kind of neat that we still have available to us some of these tax credits and other tax planning opportunities that give us a chance to reduce and or postpone our taxes into the future. So but yeah, that's about it for my presentation.